So should you dollar cost average, particularly in this environment, particularly let's say with Trump trades? It's a question which has come up in the last three emails I've received from my Great Investments Program clients. Now, the benefits of dollar cost averaging is, let's say you wanted to buy $10,000 of Tesla. Okay, you might put in 3,000 this month, 3,000 the month after, 3,000 the month after that, 4,000 in the final month. Okay, and the benefits of that is risk mitigation, because if it fell, you would end up buying for 3,000 next month more shares because the price fell. And of course, if it rose, the opportunity cost is it rose and you missed out and you should have gone all in. And there's arguments statistically that if the market is not just rising in one direction, it's a good thing to do. If the market's falling, you'll end up getting more shares. If it goes sideways, you'll probably end up getting more shares. Only if it's rising. I've written about this in my Financial Times columns as well, mathematically, etc. Of course, most of the time the market's rising. So does that mean you should just go all in? But there is an alternative, and the alternative comes from some of the world's leading hedge fund managers who I met and interviewed for my book, Mind of a Trader. So I'm going to take something from trading and apply it to investing. And the book was called Mind of a Trader. It was published by the Financial Times, and the people that I interviewed were people like Bill Lipschutz, global head of foreign exchange trading at Salomon Brothers, Bernard Opperty, who runs a $2 billion hedge fund, John Najarian, you might see on CNBC regularly, David Kite, and so on. And the alternative risk mitigating strategy that you could use if you don't want to go all in because your risk appetite is less is it's sort of like dollar cost averaging, but what you're doing is you're only adding to winners. So if in the next month the price has gone down, you skip it. You just say, well, actually, we'll just take a pause on that one. If it goes up, then you say, yeah, I want to add to the winners. Now, the hedge fund managers added to winners, never to losers, because they didn't want to average down. And you might say, well, why didn't they? Well, partly maybe because they were trading, whatever it is, but I'm applying their philosophy to this. Now, psychologically, I found that people find that a lot more comfortable, adding to winners versus traditional averaging in. Okay, so it's an alternative. It's a way that I've often done, only because it's also useful if you're adding large sums of money and you're not necessarily comfortable with doing that size a deal in one go. You'd rather have the comfort factor of adding to the winner. The other benefit of adding to winners is once the stock's already gone up a few percentage points, then remember when you buy more at that higher price, you're of course risking the new capital you've put in, but actually you're de-risking it against the profits you've already made. So that can, again, psychologically, it can be helpful. Mathematically, it can be helpful. Of course, as I say, the biggest opportunity risk is it shoots up 100% and you didn't go all in. But it's better to optimize for your psychology and your behavior and peace of mind than it is to try and optimize for what the future holds and be some kind of perfect investor, because that will lead to over trading and mental distress and all sorts of things which you don't want. It'll make you worse at it. When I set up the hedge fund in 2004, we had adding to winners as part of it was just part of the nature of the algorithms that we were using, but that was very much trend following. Anyway, and by the way, if you're wondering why I'm wearing a three-piece suit and tie, I'm going to court. Somebody has used my details, and they're being prosecuted, and I'm a witness to say they shouldn't do that. So if you're on TikTok or social media and you're watching this, you're probably not even listening to this if you are one of those kinds of people, because there's a lot of fake accounts. And while I've got you, I should say, I never direct message people on social media other than to say, no, that's not me who's messaged you to say, hey, how's your investing going? Why don't you join my cryptocurrency thing? I do not personalize one-to-one communications on Telegram. You'll notice what my Telegram links are. They're on alpeshpatel.com/links. And on there, I don't communicate with people one-to-one on Telegram. I do one, i.e. from me, to many. I'd never engage in a chat with you if you notice on Telegram. Okay, so anybody doing that, And if my Telegram link is not on alpeshpatel.com/links, it's somebody else. They use my name, they use my image, and then they send you all these little bits. If it's not on there, it's not me. Okay. And you can always email me. If you're a client, you can email me anyway. Uh, but if you're not a client, it's not me who's been speaking to you on social media, I'm afraid. Okay. On a one-to-one. I do broadcast like this, one to many. And even if you see this, if you haven't seen on TikTok, I've got a blue tick, and at the time of recording, it's about just under 500,000 followers. The scammers don't have the blue tick. Okay. Let me know if you find the scammers, because I report them to TikTok and to Action Fraud, and we're making some progress against them. Okay. Feel free to waste the scammers' time as well. Thank you all very much. Do like and follow for more.